Investors Club. I'm your host, Simon Wunderlich. Let's get right into it with VIC readings. The format will look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Equity Brands Inc. Ticker is AYI. Price and point of funding is $193.46. This is not a recommendation, not advice. Please do your own diligence before investing into anything. Let's take a look at the numbers, at the fundamentals, and let's take a look at what the price is currently. So, Equity Brands Inc. Price currently is lower, right? Um, oops. I'm sorry. I've made a mistake. Price is currently lower. Yes, it is at $163 in comparison to 193 that it was at the price of the filing. So it's now lower than when the recommendation was filed. Let's see. Maybe we have more of an opportunity. Oh, 195. I'm sorry, 96. PE is 13 or almost 14. Market cap is a 4.6. Enterprise value is 4.3. So trading pretty similar. And PB is 2.61. It's not a super cheap company, but it isn't an expensive one either. Cash to debt, 0.58. Gross margin is 42. Oh, that's good. And net margin is 9. I guess that's all right. Both is all right. It's not crazy good, but it's both all right. And RIC is 14.5. That's good. Now I like that. We want RIC at least in the like roundabout 15 or more. So that's still good though. Interest coverage 17.38. They can pay their debt. That is great. I like that. Their current debt, their near-term debt. PE ratio, we already had that. But what is the EV to FCF? Because that is more what I like to look at. Even though this is obviously just the current one, and we need to look in the future what the future FCF would be. In comparison to the EV, it's 12.41, so it's lower than the PE ratio. Okay. We got almost as much debt as cash. Not currently. Currently, we have, but historically, currently we have 223 million of cash and almost 600 in debt. So a lot more debt now, but yeah, a lot more debt now. Revenue has been growing over the last years. Net income has been growing over the last year. Operating cash flow, free cash flow as well. It looks quite good. The last 3 years had a decline in operating cash flow and free cash flow, not in net income though, and not in revenue. I wonder why that is. Why was free cash flow declining but net income not, or why was it increasing even? It's something weird, and we should look at that. Buyback ratio. Oh, they've been buying back shares like crazy. That's great. Last 2 years, 7.6 or 7.7% and 9.4% respectfully. And the years before that, around between 4 and 2%. Total assets and total stockholders' equity are growing as well. Not in crazy numbers, but they are growing. Okay, let's take a look at the recommendation. Why do they think this is also a great business? Not just great fundamentals, but hopefully also a great business. Why are the fundamentals saying like that? That's what I'm asking. Qualitative analysis. Now, description. Thesis. Equity Brands is a very good business available at a very reasonable price. It is a market leader in the stable lighting and control industry. AYI has excellent returns on invested capital and a management that has been and will continue to return substantial amounts of capital to shareholders via buybacks. This above average company is available for below market multiple of NTM EV/EBITDA 9.5 versus the market at 12.8 and peers at 14. This is a boring business, routinely posting good numbers and beating their earnings estimates. Company profile. Equity Brands is a lighting and lighting control company serving the North American market. They make all sorts of light fixtures, which they call luminaries, lighting controls and lighting components. They also provide systems to control and manage lights, sensors, and HVAC of large facilities. In plain speak, their product would go into a new build or renovated school, airport, or warehouse. The lights that light up, the fixtures that hold them, the controls that controls them, the sensors that inform them. They might also supply through their intelligent spaces group systems that would let the owners control lights and other systems, monitor their facility, and track their greenhouse emissions. The company primarily sells in the North American market, 98%, with 87% in the US, and 50-50 new construction versus renovation. 85% of their revenues are non residential. And lighting, they claim to be number one in commercial, outdoor, industrial, and life safety, and number four in residential. They sell both commodity and specialty products. In lighting controls, they are number one in commercial lighting and indoor positioning. They have 22 manufacturing facilities, again, mostly in North America, and 12,000 associates. Equity references a $20 billion annual addressable market in North American lighting and controls, compares to $4 billion in FY 2022 revenue. Equity places a large emphasis on their sales channel, where they target independent sales agents, electrical distributors, and retailers. A key strategy has been to increase service levels to distributors, and clients are often architects, builders, and contractors. They have an extremely large number of brands, shown below, and products, with about 75 new product families coming to market each year. Wow, that's a lot. That's a lot. Equity operates in two segments: Equity Brands and Lightning Controls, ABL, and Intelligent Spaces Group, ISG. Equity Brands and Lightning Control represents the great bulk of their business with $3.8 billion of revenue in fiscal 2022. This segment is slower growing and relatively lower margin. Near term guidance of low to mid single digit revenue growth and mid teens adjusted operating margins. Lighting Brands. Okay, they do have a lot of lighting brands, controls brands, components brands. I won't name them all. You can look them up. Intelligent Spaces Group is a faster growing but much smaller part of Equity's business, and therefore somewhat immaterial to the company's overall results. Revenue in fiscal 22 was 216 million, 5% of total. They're guiding towards low to mid teens revenue growth and adjusted operating margin in the high teens to low 20s. One focus in Artios, which customers can use to manage utility bills, reduce environmental footprint, and track and manage assets. This tech controls is a leader in building automation and HVAC, air control valves, connected thermostats, building intelligence, etc., etc., etc. Indicators of outstanding business. Oh, okay. I want to know those. This business has many of the qualities we look for in a high quality operation that one can hold for the long term. Excellent RIC. Okay, we've seen that. We've seen good. I don't know if excellent. Most importantly, when adjusting for the excess cash on the balance sheet and removing non tangible items from past acquisitions, equity has maintained an RIC consistently above 30%. That's not what we've seen. This company has a history of doing bolt on acquisitions, and so it is appropriate to look at this calculation with goodwill and other acquisition related assets and charges in the RIC equation as well. Going into a deeper layer than just the number. This acquisitive RIC, which is a little less meaningful as previous management executed the vast majority of acquisitions, is still in the mid teens, which is still above average. Yeah, mid-teen. That's what we saw. Oh, they saying it's at about 17 though. 16, 17. That's not what we see. Okay. Consistent and growing gap profitability. No large one-timer or consistent charge-offs have interfered with adjusted earnings becoming real earnings. Free cash flow. Over the past 10 years, on average, 98% of earnings have converted to leveraged FCF. Recent years have been above 100%. Both leveraged and unleveraged free cash flow yields are around 6% for the last 3 years, representing an attractive valuation for a stable and growing company. Operating cash flow consistently exceeds capex by a large margin. Capital allocation and capital returns. In recent years, management has returned most of the excess free cash flow to shareholders in the form of buybacks, which we find attractive since during that period, equity has been relatively cheap. They've been buying back about $500 million in shares per year, or about 20% of the company since 2020, at an average price of about $140. When adding these buybacks and the small dividend and subtracting share-based compensation, shareholders received an 8.4% shareholder yield in the last 12 months. This has been accomplished with a slight increase in debt, but management has a lot more room on the balance sheet to continue buybacks in excess of free cash flow over the next few years. Valuation does not increase. Strong balance sheet. Equity is a strong balance sheet with a net debt of only zero point 0.5 to EBITDA, which compares favorably to electrical component and equipment peers at around 1.8. Revenue growth. Through its history, AYI's revenue has been in excess of GDP, but without many material acquisitions in recent years, it had dipped to mid single digits. They are guiding to 6% revenue growth for the year ahead. To the point before that, I don't like to look at comps. I don't like comparable valuation because it doesn't make sense to me. I mean, I get the point. I get the idea. Looking at what other companies that are quite similar in the same industry for to say are trading at, but it assumes that they are that not the whole industry is over or undervalued. That they are not over or undervalued. You know. I mean, I still get it when other investors are investing in these companies. Why aren't they in that company if it is just as great? And they should and they will to bet on that. I get it, but still, it is it assumes that the market is correct in these companies. Um. hmm. Revenue growth. Through its history, AYI's revenue growth has been in excess of GDP, but without many material acquisitions in recent years. It has dipped to mid single digits. They are guiding to 6% revenue growth for the year ahead. Stable business. No commodity exposure or risk of sudden obsolescence or catastrophic event. 50% exposure to remodel slash retrofit helps smooth the impact of the commercial building cycle. Factors affecting future performance. The essence of this pitch isn't an attempt to judge the immediate future, but rather to point out that equity is a good company available at a cheap price. Nevertheless, here are some positive and negative trends of factors affecting the business. Green trend. Retrofitting. This is a super trend that the company talks about extensively, that mostly consists of retrofitting existing space for more energy efficient lighting and using sensors to light less, slash only when needed. However, while this is a reason sales can grow in excess of new construction slash a simple replacement, it is one that has been going on for a while that I wouldn't expect to materially accelerate results. Controls. Installing additional controls and luminaries is another trend, increasing overall spend in the space. As more control than simply on off continues to become more popular. Everything is also trending towards wireless controls, which again represents additional spend. Healing of supply chains. This is both good and bad for AYI. With supply chains healing, equity can do less anticipatory ordering and improve their capital efficiency in coming quarters. Unfortunately, AYI's customers will probably do the same and be working their own access inventory, so there could be a slight dip in new orders. Chips. The increasing availability of chips should remove a materially inflated cost for equity and one that they had raised prices to offset. Infrastructure. Equity is well positioned to capture some of the coming legislatively driven increase in infrastructure spending, which should be a multi-year trend. Slowing home sales. This should only be a minor headwind as the company is 85% non-residential. Onshoring. They're ahead of the curve a year as only 20% of the product comes from Asia, with most of the remainder being in Mexico. Potentially slowing commercial construction. This is the big one. And potentially the most important factor affecting equity's performance. Large changes in WFH habits will certainly hurt office construction and is something to watch. The leading IAI Architecture Billings Index is indicating a slight contraction at 49.3%, 49.3 in January, though that represents an improvement over the last 2 months. Return expectations. In general, owning good companies at cheap prices should produce favorable returns over the long run. Forward PE is 14 versus its long term average of 17.6, and EV slash EBITDA is 9.5 versus its long term average of 10.5. Revenues growing at 7%, assuming no lift from acquisitions. Margins staying flat. Share repurchases decelerating to 4% a year. Slight multiple expansion to 17 PE, still below long term average, can result in a nice high teens IRR or stock price of 250 in 2024. Catalyst. Continued solid performance and share buybacks. Thank you very much for tuning in and see you next